Welcome to Edison's new series, Real Assets in an Uncertain World. We live in an era of increasing geopolitical instability, higher inflation, and tightening monetary policy. Can investing in real assets provide sustainable, less correlated returns? Industry leaders from sectors such as renewables, infrastructure, media, and technology are joining us to reveal their views and deliver actionable insights for a global audience. In this session, we're highlighting ADIG, Aberdeen Diversified Income and Growth Trust. Now, rather than focus on a specific asset class, ADIG invests across asset classes. To tell us more, I'm delighted to welcome Nalaka de Silva, Head of Private Market Solutions. Hello.
Hi, Vivienne. Nice to see you.
Why multi-assets?
Look, I think as you described, the economic environment has completely changed over the last little while, and looking forward, having as many tools in your toolkit to navigate the high inflationary environment, geopolitical trends, where we are in terms of monetary policy and tightening around the world. Having a multi-asset portfolio really allows the portfolio construction team or portfolio management team to be able to navigate that. So being able to invest across both public and private markets, and then within those baskets of equities, fixed income, infrastructure, these are all tools that a multi-asset portfolio really brings to bear in these particular times.
And a lower risk than that of global equities?
Absolutely, because it's the type of investments that you have the choice of making. So if you're invested in an equity-heavy portfolio, you're going to carry a lot of beta, which will move around with the market. And being able to diversify that across, say, infrastructure, real estate, credit assets, into businesses, both public and private, and the streams of debt that might capitalize those vehicles, that results in a blended volatility, which tends to be much lower than that of global equities.
And I think we've made the case, just actually from looking at the newspaper headlines alone, that 2022 is probably a good year to invest in it.
Well, absolutely. I think, this is the time that, and for those who have been following ADIG for a little while, we've been repositioning the portfolio to be more sort of private market oriented, to have less correlation with equity markets. But going into a downturn, it's really making sure that you've got assets that have got a high degree of resilience over, the next, say, 3 to 5 years, particularly as we go through, a rising interest rate environment as well.
Now, there are plenty of folk with multi-asset investments, but what marks out ADIG from its peers, and what's your investment objective?
So ADIG is really a unique portfolio in terms of the flexible investment sector. We have a full asset allocation across public and private markets, which not very many people do. So that's investing across fixed income, both domestic and emerging market fixed income, looking at equities in sort of its broadest form, and then private markets making up over half of the portfolio now. And private markets being everything from venture capital, real assets such as infrastructure, real estate, natural resources, and then private credit, income streams from private companies or lending to private companies, and then alternative assets such as royalties and these types of investments which are less correlated to equity markets. So in ADIG's portfolio construction, it's fairly unique in of itself. And then you've got the depth and breadth of Aberdeen's investment team supporting that. So, there's over 350 people in the private markets division and 14 locations around the world sourcing deals that were, curated for the portfolio for the purposes that we've tried to describe, navigating these economic conditions. So really ADIG provides that, fairly unique access route into private markets and a very strong asset allocation framework across public and private.
Now, many people are looking for income at this particular moment. Is ADIG the right fund for income-seeking investors?
Look, we think ADIG is well positioned around its income stream. We actually de-risked the portfolio 18 months ago, sort of trying to as we were thinking about what might happen in markets as markets roll over, because valuations were getting fairly expensive. And we did move into more income generative parts of the market. So our infrastructure holdings were increased to do that. We took in positions on the private side on private credits to generate more income in the portfolio. And so I would say about 80% of the income in the portfolio is visible and reliable over the next 3 to 5 years. We've got 2 years of dividend reserves to cover our dividend, which makes it a very stable dividend proposition. But we're not all about just the income. There's also growth potential in the portfolio as well, because once you skew too heavily to income, you might lose some of that growth potential. So we've left some options open for growth to come out of, particularly going into a downturn, taking investment opportunities that might generate growth as well. So as we currently stand, I think ADIG, with its dividend stream of sort of 5.4 cents per share, is a very stable, income play, at this particular point in time as well.
Now, you had a new team in 2020 and you had a big strategic review and you changed your strategy. What's changed?
So it was really sort of two things that changed. One was repositioning the portfolio for the longer term and looking at sort of where markets were at 2 years ago, which was a very different place, pre-pandemic, Ukraine position, pre-inflation. So what we were really looking to do was sort of forecast a few years forward to see how we could build a resilient portfolio for investors over a 5 to 7 year period. And that really meant increasing its private markets allocation. Now, little did we know that in that strategic change, we would be positioning ourselves for where we are today, which is a high inflationary environment with high geopolitical tensions globally, and a monetary policy cycle, which is causing a lot of concern globally. So we're really pleased in the fact that we actually implemented that fairly early on in that strategic review. We moved to 44% in private market assets, once again positioning that into infrastructure assets, into high quality income streams of private credits, and then buying some private equity and venture capital portfolio, giving us that growth. So those were the major strategic changes, was to protect the dividend stream that we currently have and grow it, and also give us the option around growth in some of these areas where we can sort of transcend economic cycles. If we think about the investments that are going to be in infrastructure for 5, 7, 10, 20 years, these are going to kind of go beyond current economic cycles. And that should hopefully give investors some confidence around essentially the reliability of the NAV and the income streams that are generated by it.
So is the current portfolio in the shape that you'd like it to be in terms of sectors and assets?
Yes, we think so. So we did most of that heavy lifting 18 months ago, and it took a while to get those implemented into the portfolio. But I think where it currently stands now, with the portfolio very much positioned around high quality income streams, whether it be real assets, whether it be credit. We shrunk our equities portfolio significantly at that point in time, knowing that we would see some equity volatility on the equity side. And that's, from an asset allocation perspective, given us sort of more tools to work with when we moved into the downturn. As we continue to move through the downturn, that will give us optionality in terms of taking new investment opportunities on to generate returns. So we think we're as positioned as we can be. It's hard to tell what the next 6 months will hold. There's a lot that's moving around, and my crystal ball is probably as good as anyone else's. But I think from a current portfolio positioning perspective, we've got very reliable cash flows in the portfolio, which investors can look through and see. A lot of those are embedded in long-term thematic sectors, whether it be decarbonization, looking at renewable energy, looking at social infrastructure. These are things that are going to be required well beyond economic cycles. And from a credit standpoint, we're providing high yield opportunities back to the portfolio, which is then going to be dividend out to investors. So we've got that really nice balance between income and growth happening.
Thank you so much, Nalaka. And it seems to me that your crystal ball was in pretty good shape in 2020. So well done for that. Thank you so much.
Thank you very much.